How bad is the current banking crisis? Well, certainly if you look at the stock market, you'll realize that lots of people are very concerned by it. In this video, I'm going to explain exactly what's happened with Silicon Valley Bank and explain exactly why the market's reacting as it is. It's a difficult situation for many, particularly people, of course, that have money invested in banks. So let me explain the current situation and then you can see what action, if any, you need to take. First of all, what's happened? Well, a bank in America, the 16th largest bank, so it's a very, very large bank in America, has invested money over the last few years in government bonds, in government-backed Treasury bills. What does that mean? Well, you invest, let's say 100, and it doesn't matter the currency, but let's go with dollars. You invest 100, and right at the time they were investing, the interest rates were around 2%. So imagine you bought this government bond and you invested 100 and it gave you $2 each year for the next 10 years. Okay, of course, by locking in these interest rates, they felt at the time they were actually locking in higher returns, because when they looked at the market, they would have got a slightly lower return if they'd have just bought the government bond for a shorter period of time. However, at the same time, you had inflation already going up. So it was mismanagement, in my opinion, of money. You shouldn't be directly investing in a 10-year government bond, particularly at those low yields. Nevertheless, that's what the Silicon Valley Bank did. They invested in Treasury bills yielding around 2%. So then you can imagine, as inflation came along, you're holding something that's yielding 2%. The Fed rightly put up interest rates. So people will say, well, this is the government's fault. The central bank has increased interest rates too quickly. But that had to be done in order to slow down inflation. So let's imagine, for this example, that interest rates go up to 4%. You're holding something, you paid 100, it's yielding 2 per year for 10 years. And all of a sudden, the government are issuing Treasury bills which pay 4 per year on the same 100. So your 100 that you've invested, giving you 2, devalues. Okay, you actually get your 100 back at the end of 10 years. So it's not exactly 50%, but you can see by investing 100, getting 2 per year, 100 back, or you could now invest 100, get 4 per year and your 100 back. Why the certificate, the Treasury bill you're holding, massively devalues. No deal of diversification. They could have insured the risk. They failed to insure the risk of interest rates rising. It would be normal for a bank or indeed a pension fund to indeed insure it. So if interest rates rose, they were actually hedged or covered. They hadn't done so. In fact, it was known at the end of the year, last year, that they actually had exposure to the wrong levels of investment. So let's go back. Imagine you've got lots of clients who have deposited money with the bank. They promised them a particular return. They now have to increase the return that they're offering their clients. Otherwise, they don't have more money in. The bank functions on receiving money and then being able to lend that money out. Of course, when you're in that situation, if all the clients take their money out. So imagine, let's go for 100 billion just as an example to make it as clear as I can in a complex situation. If you've got 100 billion in your bank in assets, 100 billion's come in from clients. You're holding 100 billion, let's say in Treasury bills. Let's say that 100 billion goes down to 60. Okay, let's then say that clients start taking their money out because your interest rate is too low. Okay, you have to raise the interest rate. If you don't, then people take their money out. Let's say you don't raise the interest rate. Let's say 20 billion comes out. So now what you've got is you've got 80 billion that you've had to in your bank. Okay, 20 billion's gone, but of course you've got exposure to this 60 billion or 60 billion of assets. That's come down a little bit. Okay, in actual fact, that's 40, that's 80, it's only 50% of the assets. So the more people take money out, then the more you actually end up with a negative situation. So just imagine you've got this bank, and the more people that take money out, the more the information was out. And last Wednesday, the information was in the marketplace, more people took their money out. Of course, at some stage, they've got to stop that, because if they don't stop the people taking their money out, then of course you end up with paying money out and you've actually got a minus, you've got a deficit on your balance. Okay, how on earth did it happen? Well, Donald Trump released or tried to reduce regulation. Okay, so that is part of it. How did it happen? Well, regulation was slightly lighter than it had been in the past. Would it still have occurred? Of course, there's still the full facts to come out. That's a possibility. Okay, then on top of, not only is there perhaps a lack of regulation, then on top of that, you've actually seen a situation whereby it's been a mismanagement of money. The bank was set up really to help Silicon Valley, to help businesses, small businesses develop. Okay, here's the further issue. Branches around the world doing exactly the same thing. Of course, they all have some relationship to the parent company. Okay, so you've got one bank all of a sudden having to shut. Regulator comes in. Okay, now what happens? People are looking at other banks saying, okay, who's next? All right, what's going to be happening? And you get, they call it a bank run. What you get is people taking money out of banks. And if everybody's taking the money out of the banks, then of course that makes banks vulnerable just by the fact that people are withdrawing funds. Okay, where does it stop? Well, what's happened is the US Federal Reserve has stepped in and said, we will secure depositors. In other words, we'll look after people that had their money deposited. So that means the only people that lose are people that have equity in the bank. The people that own the bank, okay, their shares potentially become worthless, depending on if there's any assets left after the whole thing has been unwound. Okay, so market went, okay, that's good news. In fact, you actually saw some positives in the market because the Federal Reserve were doing the right thing, adding liquidity to the market, shoring up the market. Okay, however, some questions come in. What questions come in? Okay, well, there's a domino effect. What's the domino effect? Well, how many people had their money there? Where did they lend that money? Okay, what problems is that going to cause? What other banks are in this same effect? So this domino effect of lack of confidence. And it really is. Who else has mismanaged money? Who else did this? Who else bought a whole load of government treasuries or government gilts at exactly the wrong time? Okay, you'd hope that there was very few, but of course this nervousness adds to perhaps a banking system that perhaps is less fragile than people believed. In fact, we actually believed that after the 2008 crisis that the banking system had really been shored up. Okay, so we're seeing bank shares fall. Does that give an opportunity or should you sell? Okay, of course, it's an opinion. Okay, my opinion is that banks, yes, it's going to be volatile. The bigger banks, 100% for me, and it's an opinion, are going to be shored up. They're going to be looked after. Smaller banks, they may be bought by the larger banks. We're going to see, in my opinion, a consolidation in the industry. Should you worry? Okay, well, I would always say diversify. Okay, the reality is if you've got all your money with one bank, that's the wrong thing to do. I always believe that you should diversify investments and try and make sure it's not all in one place, because if you've got all your money in one place, okay, well, in life, that's unfortunately what happens is that things do occur from time to time. We need to limit that downside. Of course, some people as well will say there's billions again being given to the banking industry. That right now, the liquidity added means that banks really are in a spot where they can actually almost, just make money quite relatively easily. Okay, what's happening is governments are encouraging the banks to make sure they make money and shore up their finances. Okay, well, so many people will say, well, great, putting the money to the banks, but there's so many other sectors that need to be looked after. Okay, what should you do right now? Okay, well, if I owned particular banking investments, particularly big banks, 100%, I wouldn't sell. If I was brave, okay, I am, then I'd be looking at particular banks that I would actually purchase shares in. Okay, that's a brave decision, by the way. That's not something that I would suggest to somebody ordinarily. In other words, I would always say 80% of your money, diversify, put it in good, managed funds, multi-assets, and you might speculate with a small amount into some banking organizations or some other investments. It's speculative, and nevertheless, there may well be opportunities in that sector, opportunities that I would want to take advantage of. Okay, what's the lessons for the future? Well, first of all, we actually need to get back to more regulation. Sounds scary, but actually we do. We can't be letting these things happen. Okay, that is definitely a lesson that has to be learned. What else can we learn from it? Well, we can learn that not only is regulation important, okay, but also this fast interest rate rises from the Fed being so aggressive actually can cause other problems in the economy. So what we actually need to see, and we think we're going to see now, slower, if any, interest rate rises going forward. Okay, the economy needs to be allowed to settle. And again, that should be very good news for businesses and stock. So right now we're seeing massive volatility. That may well continue, okay, but actually in the medium term, the reality is that you'll have less interest rates rising. That's got to be a good thing. It means that you're going to have a more solid banking sector. That's going to be a good thing. So ultimately, in my opinion, you actually end up with a stronger investment sector. Leave a comment below. Please like and share the video.